Well, good afternoon, and welcome to the December webinar from the UNL Bureau of Business Research. This is the last of our fall webinar series, and we'll be back with new webinars in the spring semester. The topic today is a 3-year economic outlook for the state of Nebraska. This outlook is developed by the Bureau of Business Research here at UNL, and also a group called the Nebraska Business Forecast Council, which is a group of economists in the state's universities, a few from state government, as well as a few from utilities in the state that get together once a year and go through a process to develop a 3-year economic forecast for our state economy. I'm the presenter today, Eric Thompson. I'm also the director of the Bureau of Business Research and a member of the Nebraska Business Forecast Council. So I'm happy to present a PowerPoint today to all of you. I'll notice a few features of our webinar here before I get started. First, there's a chat window, so feel free to chat with some of the other participants or audience members in the webinar while the webinar is going on. We also have a question and answer window. We'll be answering questions after I complete the PowerPoint presentation. However, you can type in a question at any time or type it in after the PowerPoint presentation is complete. Either would work okay. So with those points made, I'm going to go ahead and go through our economic outlook for Nebraska. So the first thing to do in developing a Nebraska economic outlook is to consider the macroeconomic conditions in the United States overall. So Nebraska does have some unique characteristics in its economy, a real focus on agriculture, as well as some other industries such as transportation and logistics, insurance. However, Nebraska is also a broad-based economy, has a similar industrial structure to the nation. So that's just a long-winded way to say that if the U.S. economy is having troubles, is falling into a recession or having other struggles, we're likely to experience similar things here in our state. So we'll do a U.S. macroeconomic outlook first, and then turn to our Nebraska outlook. First of all, as is well known, of course, inflation is running at a high level. We just had an upside surprise on the producer price index here this morning. So that continues to be a big challenge for our economy. And the Federal Reserve Bank needs to raise interest rates to limit inflation, to bring it down and hopefully bring it down more quickly. There's maybe been a little progress in recent months, but we need to accelerate the decline in inflation to get it back to more of a normal level, because it is quite harmful for the public and for the economy. Now, unfortunately, this is kind of a challenging environment to fight inflation. For several reasons. I'll go over those in a minute, but the implication, if it's a challenging environment to fight inflation, the Federal Reserve Bank might need to go farther in terms of interest rate increases than it might otherwise have to in a more favorable environment. So it's important that there's a challenging environment, and unfortunately makes it a little more difficult to get those interest rates down. First of all, over the last 6 years or so, the nation has developed something of a shortage economy. Historically, the U.S. economy was based on abundance of land, abundance of labor. But because of some demographic changes and some policy choices, that's less true than it once was. We've had very, very slow labor growth in the economy right now. That's partly demographics with the aging of the baby boom population. But also there's been a decline in legal immigration to the United States that's had an effect as well. The nation is a little more involved in trade restrictions than it once was. New regulations, there's regulations on the energy industry that are curtailing the production of oil and gasoline, natural gas, and so forth. We've had an increase in the minimum wage recently in our state and a lot of states. Those are another example of a regulation that contributes to the shortage economy. So obviously we can have the kind of economy we want to in the country, but these sorts of policies that make the growth of labor, capital, other key factors in the economy a little more challenging does create an environment where we have, I guess it's more susceptible to macroeconomic shocks. There's less slack and ability to deal with things that come down the road, whether those are pandemics or other shocks to the global economy, whether it's some policy mistakes, and I'll get to that in a minute. The economy is just a little less able to deal with those than it has been in the past, and that has a tendency to lead to these unusual macroeconomic outcomes, such as the highest inflation that we've had in 40 years. Now, that's just the background. I think what's caused this higher inflation to a large degree is excess government spending. So I just listed 4 of the major government spending initiatives over the last few years: the CARES Act, the Coronavirus Supplemental Appropriation Act, the American Rescue Plan, the Infrastructure Investment and Jobs Act. All of those initiatives are probably still contributing to excess demand in our economy, which is a key source of our inflation that we're seeing right now. And they're still having an effect. And so that's going to make it more challenging for the Fed to reduce inflation. So the Fed's primary tool is increasing interest rates and keeping them high for an extended period. So high and rising interest rates are going to eventually limit growth and consumption in our economy. For example, declining home values and declining stock portfolios cause households to save more. When those asset values are sky high, people feel pretty confident about their savings goals, whatever those might be, perhaps retirement, for example. When those values fall, people feel like, well, I've got to adjust to increase my savings to get to where I want to in terms of my portfolio of assets. And if they're increasing savings out of current income, they're reducing consumption. So that's one factor with which high interest rates reduce consumption. Obviously, high interest rates on credit cards reduce consumption. A lot more of the dollars you have to spend go to interest rate payments rather than current consumption. There's other effects. Higher interest rates raise the value of the US dollar. That can create a challenging environment for businesses that compete in international markets, such as manufacturing and agriculture, although this is a good period for agriculture. But it could be better with a dollar that was at more typical levels. And then all these factors reducing demand can cause businesses to reduce their business investment, which reduces demand further, and often reduce employment, which again has another secondary round of reducing demand even further. And especially these secondary rounds can be what leads to a recession. Now, I think an interesting question in this particular period of slowing demand is how many jobs will businesses really shed? There's been some acceleration in layoffs recently. On the other hand, businesses have had a very difficult time hiring workers in the last few years, and then will they be especially reluctant to let workers go given the challenges that they've had? So that's a key question when we think about the outlook for the economy, as well as those rising interest rates. So the severity of the most likely outcome for the US economy, the expectation is that there will be a recession in the US economy in 2023, with a recovery in the subsequent 2 years of 2024 and 2025. Now, how severe will that recession be? Well, it depends on a number of things. I mentioned asset values earlier and rents that people pay. If higher interest rates can quickly cause those asset values to fall, and in particular rents to fall or stop growing so quickly as they have, that could really help a lot in reducing inflation. In recent months, rent inflation has been a big contributor to the inflation we've seen in the economy. In some months, almost a third of the increase in inflation was due to rent inflation. So if that can be halted or even reversed, that would obviously create a little less pressure on the Federal Reserve Bank to keep raising interest rates at a rapid pace. So that'll be a factor that influences the Fed's behavior. And then the second question is, as businesses face these tough times with falling demand, how reluctant will they be to shed labor? Will they be unusually reluctant to do so? That could affect how severe the recession that we have happens to be. And there is also a chance, if rent inflation and other components of inflation fall more quickly, that we could get lucky and we'll have a significant slowdown in the economy, but the economy will stagnate rather than actually decline. But the most likely scenario is a recession, and these factors will influence how severe that recession is. Okay, so that's the U.S. macroeconomic outlook. What's the outlook for Nebraska? Well, a recession in the U.S. economy, as I indicated at the beginning, would likely imply a recession here in Nebraska. So I can say the expectation, aka the most likely scenarios in the Nebraska economy, will also fall into recession in 2023 and then recover in the subsequent 2 years of 2024 and 2025. However, there are reasons to believe that the recession will be less severe in Nebraska than nationwide. First of all, it'll continue, we expect, to be a pretty good period for agriculture in the U.S. And obviously, agriculture is an outsized component of our Nebraska economy, so that should be positive for our economy, fighting against recession. Worker quality is also high in Nebraska. People have completed their schooling, have good work records, a lot of participation in the labor force. Folks like that are more likely to find a new job quickly if they happen to lose their job due to layoffs. Lastly, swings in house prices, that's one of the key assets that I talked about earlier, tend to be less severe in Nebraska than in some other parts of the country, such as along the coast. So that might help us a little bit in terms of the severity of the decline in demand. Okay, so here's an example of the recession being perhaps a little less severe here in Nebraska. You see in the U.S., pretty sharp decline in employment, nearly 1% expected in 2023, and recovery beginning in 2024, but it'll really be 2025 at the national level before employment growth gets back to more of a normal level. A little bit different situation in Nebraska. We're expecting a more modest decline. So year over year, comparing all of 2023 to 2022, we think employment will be down about 0.2%, just a few thousand jobs. Although there might be specific quarters in 2023, perhaps towards the end of the year, where the decline in employment is a little more severe. The Nebraska economy should bounce back a little more quickly, growing by about 0.5% in 2024, and then back up to the trend growth rate for Nebraska of 0.9%, near 1% in 2025. So that's what I mean when I say perhaps a little bit less severe recession here in Nebraska, should a recession occur. Let's look at some individual sectors to see how this will break down. This will also provide a little more insight into why maybe the recession will be less severe here in Nebraska. Looking at the goods producing sectors, but also select larger service producing sectors. So looking at goods producing sectors, obviously construction, manufacturing, agriculture are a big part of that. You see two of those here. We do think construction is going to see a decline in employment in 2023, and it'll stay at those lower levels in 2024, maybe returning to more of a normal growth rate or perhaps a little bit faster than normal in 2025. So the recovery in construction is a few years off, which you would expect given higher interest rates that'll likely stay high throughout 2023 at least. A little bit better picture in manufacturing. We do think that sector can add employment in the coming years despite the economic downturn. The reason for that is Nebraska's manufacturing sector is very focused on food processing, providing inputs to the agricultural sector. And we expect agriculture to do quite well in the next few years. So that'll also allow manufacturing to continue to make progress in our state. Well, let's look at agriculture. There were record Nebraska farm incomes in Nebraska in 2021 and 2022, right around $8 billion. We think that farm incomes can remain at or close to that level over the next 3 years. We think that crop and livestock prices, which are quite strong right now, can remain high during the forecast period from 2023 to 2025. Now, unfortunately, a lot of the inputs to farm production are also higher these days, which has created a challenging environment for farmers and ranchers, although the net effect has been a pretty healthy farm income the last few years. We do think commodity prices, first crop commodity prices and then eventually livestock farm commodity prices will begin to moderate throughout the period, and the input prices will moderate as well, although all of them will seem fairly high by historical standards. We think the crop and livestock prices will fall a little more sharply than the input prices, and therefore farm income has to fall a bit. Farm income will also fall because government payments will drop throughout the period. So, and I think one of the impressive things about this whole period, the 23 to 2025 period, is that farm incomes will be high, and it'll be high almost entirely due to earned farm income rather than federal government payments. So we think Nebraska farm income will remain near $8 billion in 2023, fall a bit, then fall back to around $7 billion in 2024 and 2025. So eventually those prices will moderate and farm income will fall back to more of the $4 or $5 billion level, but we think that's more than 3 years away. Here's the specific numbers again, a little bit of a drop in 2024 as we fall. Farm income falls from 8 billion to 7 billion in Nebraska, but still quite healthy levels for farm income, which will help our economy. Let's look at some of those service industries: retail, trade, business and professional services. Those are businesses that primarily produce services for other businesses. So when businesses are looking to cut costs, especially if they want to hold on to their workers, they might be cutting back on some of the services they receive, whether that's professional services like accounting, consulting. Obviously, you have to maintain those services at some level, but they might cut back a bit. Retail trade is also going to be very cyclical, obviously, with consumers being a little more cautious. We do think employment growth will return to the financial services sector during our forecast period. So here's what it looks like. You see a sharper decline in employment in retail trade, a decline in services. It's not quite as large. Healthcare is also part of services, and obviously employment in that sector is likely to be steady or grow, good times or bad. No growth in finance in 2023. Again, 2023, a little bit more of a challenging year, but then we see the bounce back. Services employment will grow more of a normal level at or a bit above 1% in 2024 and 25. Finance growth will improve throughout the period. Not a lot of job growth in retail trade. As I said at the beginning, labor force is growing quite slowly in the U.S. and here in Nebraska. That means some sectors are going to have to learn to do and get along with less workers. Retail trade is likely to be one of them. And so after the loss, we don't expect the employment to bounce back in the retail trade sector, although sales can. Let's look at another aspect of the Nebraska outlook. We showed earlier that farm incomes would be down a little bit. We think that non-farm income will be down in real terms in 2023. In other words, non-farm income will grow, but it'll grow slower than inflation. So real income for households will fall in 2023. That's the bad news. The good news is real growth will return for non-farm income in 2024 and 2025, which makes sense because employment will be growing in those years. So let's just compare non-farm income with our expectations for the consumer price index. Again, decent growth in non-farm income in 2023, but there's a lot of inflation in the economy right now, and real income will fall. Consumer price index will rise by more than Nebraska non-farm income. Luckily, inflation should, if the Fed keeps consistent in its actions, fall back towards more typical levels, a little bit higher than we've seen in recent years, but certainly more a reasonable rate of inflation in 2024 and 2025, and non-farm income can grow more quickly than that. So job growth and real income returning in 2024 and 2025. So if I was going to summarize it all, the expectation, i.e. the most likely outcome, is that the U.S. and Nebraska economy will fall into recession in 2023, but recover thereafter. There is some chance we'll get lucky and avoid a recession, but certainly the economy will slow to an absolute crawl during the year, or very likely it will slow to an absolute crawl, and most likely into a recession in the next year. The 2023 recession is expected to be somewhat less severe in Nebraska than nationally. Nebraska employment and real income, repeating what I said a few minutes ago, will fall in 2023, but rise in 2024 and 2025. I should also mention, as I said at the beginning, our forecast is produced in collaboration between the Bureau of Business Research and the Nebraska Business Forecast Council. We are grateful for the help of the NBFC members. Those names are listed in the report, but it's economists from the universities here in the state, knowledgeable economists in our state government, as well as economists working at utilities in our state. And we sure appreciate their efforts in collaborating with us each year to produce a forecast for the Nebraska economy. Well, at this point, I should answer any questions that you have. So I see one attendee asked, is a soft landing equate with a minor recession? Well, they had two questions. I'll ask that first. No, a soft landing would be a significant slowdown in demand that doesn't actually cause the U.S. economy to decline. So the economy might stagnate, grow near 0%, but have positive growth rather than a decline. That's what people mean by a soft landing. There's a second part of that question. If your national forecasts of a recession equate with the Fed not achieving a soft landing, that's correct. It does equate with that. So the Fed has a very challenging time creating a soft landing, given how bad inflation is, given the difficult environment, as I explained. So they may not be able to achieve their goal. The second question asks, given Nebraska's age profile, do you expect the labor shortage to intensify in Nebraska? Well, Nebraska age profile is interesting because it does vary by parts of the state. So Lincoln and Omaha have relatively young age profiles, younger than the national average age profile, but obviously the age profile is much older in many parts of rural Nebraska or non-metropolitan Nebraska. Certainly where in those non-metropolitan areas, labor challenges with finding enough labor can be pretty significant, and in Lincoln and Omaha as well. I think the problem is a little bit more severe here in Nebraska than it is in some other parts of the country. By the way, I think that's partly because our businesses are doing very well and are just demanding more workers than you see in some parts of the country, as well as challenges with supply. I know Nebraska has a very low unemployment rate. I believe that's a reflection of the quality of our workforce as much as anything else. So I don't know that a 2.5% unemployment rate in Nebraska is really any different in terms of the difficulty of obtaining labor as a 4 or 4.5% unemployment rate nationally. I see there were some other parts to this question. Which do you forecast as reducing the labor shortage problem more, automation or immigration? I think those will work in tandem. Obviously, there's more issues than just economics surrounding immigration. As a nation, we can choose what our immigration policy we want. It does create a little bit more challenge for the U.S. economy in terms of labor force growth if we reduce the rate of immigration, especially, and of course, I'm talking about legal immigration here. So that's a policy choice we need to make. Again, there's a lot of issues involved, but allowing more legal immigration could help with labor supply challenges. Automation, I think that's a nice way to say businesses will find ways to work with less labor. So we may be in a period where we have a little bit more of what I characterized as a shortage economy. But businesses will adapt to that. It's not going to be a positive for the economy, but this is still a capitalist country with a great set group of business leaders, and they will adapt to the resources the economy has available through automation, through other things to equilibrate the supply of labor and the demand for labor. So I think you've focused on two things that will make a difference in helping the economy move forward. Well, I'm not seeing any other questions at this time. Those are excellent questions. Thank you. A full report of the forecast report from the Bureau and the Nebraska Business Forecast Council is available at go.unl.edu. /bin archive. BBR webinars will resume in the spring. The lineup will be announced online at this site. You can also, we regularly produce reports about the Nebraska and larger and the economy in larger geographies. You can follow us in a number of ways you see here. You can also get on our email list to receive our reports regularly, bbr@unl.edu. Seeing no other questions, we'll go ahead and sign off. Thank you for participating and attending our webinar today.